So as the stock market continues to move higher, there's now a new warning presented by some of the best companies here in the US. Let me tell you about it here in just a second. Welcome to today's video. This is your next Wise Step video for today, Tuesday. My name's Mike Bernard. I am the host of the Wise Money Show. I'm also one of the owners and financial advisors right here at Korhorn Financial Group. If you're new to this channel, hey, welcome. Hit that subscribe button, turn on notifications, and smash that thumbs up button. I appreciate it. And as the market continues to move higher and higher, despite the economic circumstances being, very dire, it's a big new warning going on. Let me tell you about it. So I'm a big Tim Ferriss fan. I don't know if you follow him or watch him, but he interviewed Howard Marks recently on his podcast. And if you haven't listened, sometimes Tim Ferriss's interviews are really long. They're like 2 hours. This one's only an hour, so check it out. Howard Marks is the founder and co-founder of Oak Tree Capital Management, one of the best mutual fund companies and investment management companies out there. And he started actually the very first high yield bond fund way back when. Well, during this interview with Tim Ferriss, he actually briefly described his beginnings as an investor. And it was back in the 60s, I believe, maybe, yeah, it would have been late 60s. And he talked about how his very first crack as an investment analyzer was for a company, and he was charged with figuring out a way to invest in the Nifty 50, which back in the day, 50 years ago, that was basically, hey, find the 50 best investments out there, the very best companies, and let's create an investment where people just put their money just into those Nifty 50, those 50 best companies, the darling investment. So he picked the very best at the time, and I'm not going to run through the names, but it's the companies that anyone would want to invest in. You'd all agree those are the very best companies out there. And what happened to that investment? It plummeted. It did terrible, and Howard Marks says, he transitioned out of that role, but I mean, he really should have been fired. Why? Why did the very best the best investments, the best companies, the darling investments, why did they do so poorly? Well, Howard Marks said it's because their price on the stock market, their stock price had been bid up so high that by the time he created this little Nifty 50 fund, he was investing, those clients were investing at such high prices, there was no more room for those investments to continue to go up. And so, of course, they inevitably went down. So the price that you're paying, so the PE, price to earnings ratio, the price that those great companies, those Nifty 50s were, compared to at that time, compared to everything else, meant that really they could only go down. And he goes on to share a few other similarities, maybe with horse racing and some other things that you might find interesting. But how do I correlate that to today? Now, Howard Marks didn't do this. This is Mike Bernard talking here. The FAANG stocks, which is an acronym, in the financial world, is an acronym for everything. So Facebook, Apple, Amazon, Netflix, and Google, or Alphabet. And I'm actually going to include Microsoft in there as well. So the FAANG now represent 25% of the S&P 500 index. So think of this. The S&P 500 index is the most popular index to invest in. So pretty much everyone has it, and every large cap fund is trying to compare itself to the S&P 500, okay? So you got the 500 largest companies in the US, but the index isn't an equally weighted or where every company is just 1/5 of the index. It's a market cap weighted, which means the larger companies, the ones with higher market cap, are a larger portion of the S&P 500. So guys, 6 companies out of 500 now represent 25% of the S&P 500. To my knowledge, I'm going to link an article below, or some research below, but to my knowledge, that's the highest that's ever been. Which means all of us, me included, that invest in the S&P 500, hey, when those companies are doing great, wonderful. The S&P 500 index is rising faster than normal. But if those companies, those 6 companies, if I were to ask you today, hey, what are the Nifty 50 or what are the Nifty 6, right? You would say those companies. You might throw Disney in there too, because I'm a Disney fan. And you might say those companies are a sure investment. You could never go wrong. but they now represent a magnitude of the S&P 500. And what's their forward price to earnings ratio? It's nearly the highest it's ever been. It's over 60 times future earnings. 60 times. Now, these are tech companies, they're large growth companies. So in the past, it's been above 70 and it's been nearing 70. But the forward multiple, so their price relative to their future earnings, is higher today than it was before the coronavirus. Now, is that justified? I don't know. I'm not a market timer. I just look at that risk. So what should you do about it? Number one, have a disciplined investment philosophy. Stay diversified. Make sure that diversification fits within your overall comprehensive financial plan, and that's the right level of risk for you long term. But once again, the second thing you need to do is you need to make sure you have a momentum strategy. Because just like one of the most successful investors to ever step foot on this planet, Howard Marks, said, you can invest in the very best companies out there, but if you invest in them at the wrong time, where their price is so high that it's almost hard to expect that it's going to continue to go up, you might need a momentum strategy, one that even when great companies, long-term companies that you'd never want to sell, even when those go out of favor, as they inevitably will, that you have an ability to reduce risk and adapt. So we have both of those options here at Korhorn Financial Group. This is not a sales infomercial here, but we believe in those strategies. That's the type of strategy you need to have. Diversification that you stick to, that you rebalance, and it's all connected to your overall financial plan, and a momentum strategy so that you can adapt when investment changes and circumstances change as well. So, all right, I hope that helps you take your next wise step. Just want to remind you, if you didn't see that we're starting our Financial Foundations course tomorrow, an e-learning course on some basic financial skills. I don't know if that applies to you or your kids or your grandkids, but check that out as well right here on this channel at 10 a.m. tomorrow. All right, you're now ready. Go out and take your next wise step in your financial life.